You've probably heard a lot of chatter about the Federal Reserve raising and lowering rates. But you may be wondering what exactly that means for you. The Fed sets the target range for the federal funds rate, which is the overnight interest rate that banks charge each other to borrow money. They prefer to raise and lower the federal funds rate in increments of 25 basis points, which is 1/4 of a percentage point. Though sometimes the Fed moves rates in larger increments, such as 50 basis points or 0.5%. In turn, that rate closely influences the interest rates you pay on personal and business loans and credit cards, and the interest you earn on your savings accounts and CDs. Other rates you pay are less directly impacted by changes to the federal funds rate. Take mortgage rates, for example. By affecting banks' borrowing costs, the federal funds rate indirectly influences mortgage rates. But there are also other determining factors. And so, when you hear that the Federal Reserve is raising or lowering rates, it's not as simple as the Fed deciding how much interest you pay on your loans. Instead, the Fed raises and lowers rates in order to influence saving and borrowing behavior. When they lower rates, consumers and businesses tend to borrow more, which helps accelerate the economy. When they raise rates, the opposite tends to happen. This is how the Fed works to fulfill its dual mandate, having inflation trend to 2% over time and helping to support full employment, which means an unemployment rate of around 4%. Achieving these things isn't an exact science, but it's why the Fed meets so regularly to evaluate economic data and determine what to do next. And it's why we closely watch the data and the Fed's moves to keep you informed.